So now alpha versus beta, that is the question. Of course, I can beat the market, I think a lot of investors, but then they allocate the money to actively managed funds, and it turns out it doesn't really generate an excess return. And at the same time, there are hedge funds out there, so-called hedge funds, who claim they produce alpha non-stop, and they charge an awful lot of money for that. So when we look at the financial markets today, a lot of things are happening. So now first there's the rise of the index investors, changing the demand for securities. There is an amount of data unprecedented, and we have no experience what that data will make to financial markets. And thirdly, there's the evolving power of the machines. So they start to be cognitive, as they say. So we thought it was a good time to actually repeat the question, the alpha versus beta debate. Are machines necessary to extract alpha today, or is data necessary to extract alpha? And who could be better suited than Professor François-Serge Labiton? Now, he's the CEO and Chief Investment Officer of Catch Capital, an asset management firm primarily investing in hedge funds. He's also Professor of Finance at the EDHEC Business School in France and a visiting Professor of Finance at the Hong Kong University of Science and Technology. He has been a Swiss Finance Institute adjunct professor since 2010, and he was formerly a Professor of Finance at the University of Lausanne. Please, Mr. Labiton.
Thank you. Thank you. Good afternoon. Thank you very much for being here. As you can hear, I took a plane yesterday to try to convince me in the plane that global warming didn't exist. And the problem is I've lost my voice in that process. So I hope it will stay until the end. Alpha versus beta, this is a never-ending debate. And I've tried to highlight here a few surveys and the consequences of using more and more what I would call machines and data into finance. So 90,000 jobs will be lost out of 300,000. That's the first survey by 2025. So a third, basically, of the finance industry will have to find something else to do. Second survey from Preqin, a company that provides some analytics about the financial industry, says that 40% of hedge funds that were created in 2016 were, quote unquote, systematic, which means they use essentially computer models and algorithms to generate alpha and take trading decisions. 2017 survey by Barclays, I find this one interesting, found that 62% of hedge fund managers were employing some sort of machine learning capacity in the investment process. I'll come back on that. I think machine learning is becoming a buzzword. We'll discuss whether it's applied in practice or not. And this last point, which interestingly was published yesterday by the Alternative Investment Management Association, says that half of the people surveyed are making use of unique data sets, I'm using quotes here, that could provide additional insight and competitive advantage, using quotes again, in their investments. And apparently 50% of the institutional investors are using artificial intelligence in the investment process. So it looks like from these surveys that anybody that is not using artificial intelligence is a complete idiot, right? I have to say sometimes it pays to be an idiot. We're going to show why. So machine learning gains, this is a graph coming from Bloomberg that shows the performance of, let me call that asset classes to be fast. The bottom asset class is the performance of the S&P 500, right? Is the performance of a hedge fund index. No comment. Pretty horrible, I would say. The red one is the performance of a subset of hedge funds that are using artificial intelligence and machine learning. Seems much better. Now, interestingly, the blue curve is the performance of the S&P 500. And you can see that machines have failed to deliver versus a simple index strategy. Interestingly, and unrelated to the topic of discussion today, Warren Buffett is the green line, and he's also failed, right? He's beaten the machines, but not yet the indexation. Now, for today, there are 3 questions I'd like to address. The first one is, do hedge funds generate alpha? The second one is, what is the role for machines and data analytics in general in alpha extraction? And the third one is, are machines the future of alpha investing and hedge fund investing in general? Before I dig into those questions, I think I need to be a little bit more precise. What do we call a hedge fund? What do we call alpha? And what do we mean by machine learning, artificial intelligence, and all that? So what is a hedge fund? I could be relatively cynical and say it's the standard way of charging performance fees to investors. There's a lot of people that think that. My approach to hedge fund is it should be a private, lightly regulated investment structure run by smart people in an opportunistic and dynamic way with a strong alignment of interest, which means the managers need to invest their money alongside investors, and which is focusing on generating absolute returns, and of course, that charges a performance fee. There's approximately 8,000 so-called hedge funds in the world. I'm not sure many of them would tick the box on the second definition. All of them tick the box on the first. Now, what is alpha? Alpha can be said, value added by a manager. This is not really a very precise definition. If we adopt a more academic approach, we could say that alpha is the consistent, unexplained source of return. Essentially, running by a regression, kappa model, whatever you want, you compare the result of a manager to the result of the market, and whatever is in excess, taking into account for beta exposure, is called alpha. Generally, if you take this approach, you don't just use the market as an explanatory factor. You will add additional factors, additional models, additional risk premia in your model. The more factors you're using, the smaller the alpha. Alpha is more and more explained as you add factors. And that's something to keep in mind. Alpha 15 years ago was assessed using very simple techniques and was very large. Alpha today is assessed using very complicated techniques and can always be explained. A manager that would just buy one stock, that's the ideal stock picker, right? You can't find a stock picker more convinced than that. He holds one stock in his portfolio. Let's say it's Apple. Fantastic return. Well, actually the manager didn't add much value, right? Because he's invested to a large cap, US biased, growth, tech, etc., etc. So I can explain Apple by 16 factors and at the end say to the manager, you're a beta player. Well, yes and no. I mean, what matters ultimately is the return generated, and you would need to set those factors up front, not after the fact. In practice, I think there are three sources of alpha. So the first one, I would label it incorrect modeling by investors and analysts. If you regress the results of a hedge fund versus the S&P, you get a large alpha. Why? Because it's supposed to be uncorrelated. So anything unexplained by the S&P becomes alpha. Very simple. We'll ignore that here. The second one is luck. Some managers have been lucky. Financial markets is a place where you can be lucky for a long time, even if you do the wrong things. Again, we'll try to ignore this. The third one, alpha should come from active investing by talented portfolio managers. This is the alpha we're targeting. So now we can address the first question. Is there alpha in the hedge fund world? This is based on a hedge fund index where I'm simply assessing the alpha of the index versus the S&P 500. The dotted line on the top is the alpha based on just using the S&P 500 as a factor. The alpha at the bottom, which is the thick line, is using a six-factor model. Simple six-factor model, right? The conclusion is roughly the same. There has been a little bit of alpha. This alpha, by the way, is a monthly alpha, just to be clear. So if you allow me to annualize by multiplying by 12, I would say in the 90s, the alpha was approximately around 10% a year. And then it decreased. It decreased pretty dramatically and pretty consistently. And I would say the alpha now has been around 0, right? This is after fees, just in case you were wondering. So I would say more recently, hedge funds, in average, have not really generated any alpha. We could look at funds of hedge funds. Funds that ideally select the best hedge funds. Same story, same approach, same models. What do we see? Well, not very surprising. They haven't really generated alpha since the 90s, right? That's been like that for quite a long time. Of course, there have been little periods with negative alpha and little periods with small positive alpha. But on average, I would say this has been trending around 0 in a pretty stable way. So Doesn't seem like there is a lot of alpha in the hedge fund industry as an aggregate. More worrying is a large part of the hedge fund returns, again, in aggregate, are coming from markets, and markets here is S&P 500. How much of hedge fund returns are explained just by looking at the market? In the 90s, down here on the left, it was 3% for fund of hedge funds and around 50% for single hedge funds. Today, you can look at the picture on the right, it's around 60 or more than 70%. So close to 2/3 or more than 2/3 of the returns are just coming from beta, from the markets. Now, should we care about the average hedge fund as measured by hedge fund indices here? My view is no. And simple answer to it, the first one is the size of the average hedge fund is ridiculously small. If you look at this picture, which is coming from hedge fund research, we've got a sample of funds, approximately 10,000 hedge funds and funds of funds. The blue part of this curve means that more than half of the managers run less than $10 million, right? So the average hedge fund size, or at least, let me rephrase that, the median hedge fund size is less than $10 million. I personally do not care because I'm not going to invest in that segment, as simple as this. Now, if you take thousands of these people and you measure their performance, great, but it doesn't apply to me. Now, if you look at the right pie chart, it says that more than 80% of the assets are run by a firm that run more than $1 billion. So the hedge fund industry has a lot of very, very small players, more than half the industry, and the assets are primarily run by a couple of very large companies. So we need to be very cautious when we talk about the average hedge fund. Now, well, should we have expected these results? I think so. First is the average manager, hedge fund, mutual fund, whatever you want, is average. Why would it be different, right? The average manager is average minus the fees. And fees in hedge funds are high. So high fees and you're average means you're below average. As simple as this. The second thing is the more and more alpha is exploited by a group of people, the more and more it becomes beta to the market. Market means explainable sources of risk premia if you want. A good example of that is momentum, right? Momentum has been exploited by a larger and larger amount of people to the point that it has now almost become a factor. So it's no longer alpha, it's becoming beta. Alpha is killed by the non-netting of performance fees. Let me just give you a simple example. I have two managers in my portfolio. The first one buys Nestlé, the second one shorts Nestlé. Same size, to keep things simple. Very bad news for me. Why? Transaction cost? Not really. I mean, that's not the key point. I'm going to have to pay a performance fee to one of those two, right? Because one of those two is going to be a winner. And the second one will just lose money. So if you have too many managers, and a hedge fund index has 3,000, 4,000, 10,000 hedge funds, I mean, you will have, by definition, those long and short positions that are netting out your exposure, but not your fees. And basically, the performance comes down because of that. Next point, alpha is a zero-sum game. We keep forgetting about it, but the only way to get alpha out of a financial market is to find a dummy investor that will lose alpha. Right? So the problem is there's so many hedge funds that have been created that we don't have enough dummies to generate this alpha. Okay? There is nowhere left to sort of feed all the hedge funds in terms of alpha. So as a result, a zero-sum game, again, minus fees, becomes extremely problematic on average to perform. So for me, asking whether the average hedge fund has delivered alpha or not delivered alpha is a complete waste of time. My view is no. The average hedge fund has not, will not deliver alpha. The average mutual fund has not, will not deliver alpha. The average minus fees will not deliver alpha. As simple as this. The right question for me, and I'm an allocator in hedge fund, I'm running basically what we would call a fund of hedge funds, is whether we can find managers hedge fund managers that deliver alpha, and I'm comfortable with the idea that they will continue to deliver alpha. That's the first thing. If I can identify them, that's great, but then the next question is, can I allocate to them? I mean, can I get access to their portfolio? I'm just going to give you 3 examples of my portfolio, 3 allocations we have. I'll hide the name, but that's the first manager. It's our largest position. It entered our portfolio in 2002, day 1, basically. The line at the bottom, the blue line, is the S&P 500. The red line is the performance after fees of the manager. We can run alpha statistics, etc. It's a manager that has an exposure to the market that varies between 0 and at the peak 60%, right? So the beta has been from 0 to 0.6. There is considerable alpha. There's been essentially 1 year with negative alpha since the manager started. 15% of our portfolio, high conviction. Interesting point, the manager returned 1/3 of its assets, thinking that it has grown too much because of performance and wants to remain quote-unquote small and continue to deliver this alpha. Now, this is a discretionary manager, so not really systematic, not really machines. It's about visiting companies, knowing management, and traditional stuff. The second manager, interesting track as well, second largest position in our portfolio. It's around a 10% position. The line at the bottom, I mean, it's almost a flat line, I would say, is the S&P 500. The red line is the manager. This is a manager that is 80% computerized and 80% about machine trading. Essentially statistical arbitrage, futures trading, etc., etc. It's been evolving over the years. The beta is 0, close to 0. So you could argue that most of the return is coming from alpha. You can find a couple of explanatory factors, but it's really hard. I mean, we've been trying for a long time. It's really market neutral. The third manager here, it looks like a Madoff line, right? Almost. Madoff that would have gone crazy at some point. But the third manager is actually our smallest position. You're going to say, why do you show us your smallest position? Well, I wish I could quadruple my allocation. This manager has been hard closed since we've made our only allocation to it. It's 100% computer driven, and it's 100% market neutral. It's about 1.2% of our portfolio. So this is an example. These are examples, I would say, of managers that have generated alpha, were identified as generating alpha, and are constantly evolving to continue to generate alpha. And they've been successful at it. So for me, this is the right question. Can we find, and I don't need 6,000 managers that generate alpha. I need a couple, and then I can create a portfolio if they're all different from each other. Now, can machines help? Passive investments, I think, is better run by machines than by humans, right? Less mistakes, cheaper, etc., more efficient. Systematic investment strategies, I'm thinking here essentially about statistical arbitrage, about trend following, CTAs, etc., are probably also better run by machines to a large extent, right? You probably need a bit of a human brain to stop it when the machine gets crazy, which means when the markets get crazy. But most of it is automated. I think the next question for these strategies is whether the algorithm can be developed by machines instead of being developed by humans and then applied by machines. Okay, and this is what artificial intelligence, machine learning is about. So it's still a question mark. Fundamental hedge funds, and the majority of hedge funds are still fundamental, I think, are more and more using data. And they're buying data, they're analyzing it, and they're using that to find and validate ideas. So examples of data, credit card data, internet traffic, job posting, social media discussions, satellite imagery, I'll give you an example in a second, credit card, and so on and so forth. They're buying data sets, and they're checking their ideas. 3 examples. I know one fund that is matching mortgage data with credit card data and auto loan data in the US. And what they're trying to say is, well, if you've defaulted on your credit card and you're defaulted on your auto loan, it's very likely that you're not going to repay your mortgage, right? So one has an influence on the other. If we can get this data together, we got better predictors at where are the likely defaults, how it will affect securities. This manager is essentially trading mortgages, just to be clear. The second one is a long-short equity fund. Is using computer vision algorithm, so he's buying satellite images, analyzes them through computer vision algorithm, and matches it with mobile phone geolocalization in order to figure out how many people are visiting shops, how much time they spend there, how much they're buying, etc., and try to predict earnings based on that. Pretty sophisticated. You can just think about the cost of doing this. It's not nil. It's one of the most expensive managers in the industry, but they were doing this. The third one, natural processing, essentially going through websites, going through different boards, etc., and blogs, and analyzing natural language and try to figure out, which brands are criticized, which shops are criticized, what is customer opinion, and how likely is this affecting ultimately the earnings of those companies. These are very practical examples where data can help. Now, computers are very good at classifying, screening, identifying patterns in large samples, outliers as well. I think they're very bad at what I would call small data. Everybody's talking about big data. Small data is sometimes as important as big data. You might get one piece of information, one data point, that will really convince you that the thesis is right or the thesis is wrong. Computers are very bad at this. They're very good at using thousands of data and finding things that human eyes and brain would probably not recognize. Now, if you allow me, I will use an example, which is the example of chess. I'll tell you a small little anecdote about chess. 30 years ago, I was a software engineer. I started my life as a software engineer. And at the time, 30 years ago, it was about writing chess programs. That was really the beginning of writing serious chess programs. So I spent approximately a year and a half of my life writing a chess software, right? And the reason I wrote that is because I bought a couple of chess software and I was beating them regularly. So I decided to write my own, and with a colleague of mine. And at the end, the problem was computing power was not there and storage was not there. To give you some insight, we're using floppy disk. The size of the floppy disk was a few hundred kilobytes, and we had a hard disk which was 20 megabytes, right? So that was the computing power we had. The software was very good, but it was not able to calculate fast enough. So I basically stored that was 30 years ago, and didn't think about it. Recently, I rediscovered this software, readapted it, run it on my machine. Essentially, guess what happened? The computer beat me, but seriously beat me. Now, computing power is like 1,000 times of what he had. Storage was like, gigabytes of hard disk, etc. So what did I do? I played again, and it beat me. And I played again, and it beat me. So I was very frustrated. Ultimately, I decided to cheat. So what did I do? Well, the program that we wrote had a classification algorithm. It was the early days of artificial intelligence. It was trying to classify you as a certain type of player and then exploring solutions that were based on the type of opponents he was playing. So what I did is I started playing in a certain way. I guess, we didn't track it, but the computer classified me, and then I changed my style. And guess what happened? The computer continued exploring things that I was no longer playing, and I won, right? And then I switched up my computer and never played again. That was over. Interestingly, Kasparov, when he lost against Deeper Blue, which was the last large chess that he played, was puzzled by a computer move. He didn't understand it. And it turned out after the fact that this computer had a bug. So the play of the computer was a bug, and Kasparov was lost, didn't understand that. Basically, the computer made a mistake. So I tried to reverse it, and I did a mistake, but that was a voluntary mistake. Now, let's go back to financial markets. I think financial markets are very different from chess. Chess is actually a very simple game. There is only one player in front of you, and we can assume that he or she is rational, right? The second thing is the chessboard is a perfectly defined environment. How you move the pieces is extremely well defined, codified. You can't change it. There is an objective function which is perfectly defined. You know what you have to maximize. You know what you have to do. You can build a model to play chess. And if you have a model, a set of rules, a perfectly defined environment, a computer is very good at optimizing these things. And if you let it go with large computing power and storage, it will win. Financial markets, investing is a bit different. Why? You got thousands of players. Each player has unknown and sometimes changing objective functions. I mean, we did discuss goal-based investing. Everybody has different goals, and everybody can change their goals. So that's a good example where things are going to change, the environment is going to change. Now, the environment itself is stochastic. Things are moving around, and it doesn't follow a set of rules. Quantitative easing is a perfect example of there is no rules. The central bank sets the rules, right? And markets have to follow. The player's behavior is reflexive, which means it influences the environment in which you play the game, and changes in the environment influences the way the players behave. Plus, some of the players are irrational, which doesn't help. My view, again, as a software engineer, as a hedge fund believer, not hedge funds, but a couple of hedge fund believer, is that that is a much more difficult environment today, given the computing power that is available, to codify into a model, and this model will turn out into something valid. I was discussing before, I have met in my whole life only one fund that I would call serious machine learning applier. And what I mean by this is it's a fund that is only doing machine learning, has been doing machine learning for more than 8 years, has recruited the best people from the best academia, essentially on the West Coast, but even globally, has 60 or 80 people working on machine learning. 30 of them are ex-university professors, PhD researchers, etc., etc. They're focused on machine learning. I had my best, most interesting conversations with those people. Intellectually interesting. I would say their performance is okay. That's the way I would describe it, okay. They're not in my portfolio, just to be clear as well. I like them, they're great, I enjoy the conversations with them, but the results haven't been there. Will they be there one day? Maybe, I don't know. In 20, 30 years from now, 30 years ago, I would have said chess will never win against a human. Turns out that chess have won, and the only way to win against a computer is basically to misbehave, to become irrational. So today, I think it's a bit similar to that. So the limits of using machine, I think big data has huge barriers to entry. I mean, there is a survey by Deutsche Bank. There is 1 billion websites on the internet, 100 million more added every year. If you need to go through those websites, it's going to take a ton of time and machines. 500 exabytes of data, 90% of it being created in the past 2 years. I mean, just think about the amount of computing power to go through that. So the barrier to entry is high here. More data means you need to clean it, you need to structure it. I mean, having data is not enough. You need to be able to exploit it. And then you need the algorithm to exploit the data, or you need to have the computing power to basically let the machines analyze the data and find patterns. So I don't think small hedge funds can afford to have that. I mean, it's going to be a big player game. A large number of hedge funds today claim to be using big data and machine learning. I get on average 5 to 10 emails a day about, I'm doing machine learning, do you want to look at us, whatever. The answer is no, we're not interested. I mean, we think if people are doing serious machine learning, there is probably 10 companies in the world that can do it. Half of them, by the way, are not hedge funds. They're unicorns or whatever you want to call them. But it is mostly marketing. I don't know small hedge funds that do it seriously. If you let the machine 100% in charge, as some funds have done, then they come out with patterns, but they're unable to explain them. Do you want to put your money on statistical, historical patterns? I'm of the old school. I like to have a model, right? This is the assumption. I test it. It's validated. I think it's going to continue. I invest. That's at least my approach. There is a few questions around that as well. Using information obtained from consumers poses a certain number of questions about privacy, right? And we can look around at a couple of laws around, a couple of court cases. It's not really sure on, where is my data going and what are those people doing with it. There is also the question of, it's called publicly available data, but where's the frontier between publicly available, but I'm not aware of it, and private information, which then questions, the frontier on which play of it are you. If it's an algorithm that works on that, I'm not sure the algorithm knows the limit. So also a question, food for thought. The interesting last point is some humans have started arbitraging machines. There's a number of places where machines have been put in place, and humans are actually found ways of playing against the machine and made a substantial amount of money. Index arbitraging is one of them. Futures rolling is another one. There are massive flows into passive investments. There are companies that have two share classes, exactly the same thing except voting rights. One of the share classes is in the index. The other share class is not the index. The one in the index is 30% higher than the other. It's the same economic rights. Doesn't make sense, again. But it's only driven by flows. If you can arbitrage flows in an intelligent way, I think there is a lot of money to be done. Now I'm coming to my conclusion. Again, a Bloomberg slide. This is showing you the results of machine learning hedge funds. Great until recently, right? Now, I don't know what the future means. We shouldn't extrapolate from 1 month, but basically it seems like more and more people claim to be doing machine learning. Recently, there's been a couple of large disasters. I hope that machines will learn out of those disasters. We'll see. And finally, I will end up with a cartoon. Machines in alpha, so it's again chess. The man teaches machine to play chess. The man defeats the machine. Then the machine improves, and the machine defeats the man. And then the machines defeat the man over and over again. The man gets angry and says that chess is a stupid game. And the machine says, no, it's you who is stupid. They basically agree. Then they make up. They agree to play chess again. And occasionally the machine lets the man win from time to time, so that the man thinks is smart and the machine can continue to exist. So yet to be seen is something like this happening in artificial intelligence, where a machine would start losing money just to make sure that some people on the other side think that they continue to be smart. Thank you.
Thank you very much. You covered a lot of ground there. Before we go into the panel, we have maybe 5 minutes if there are any questions at the moment. It's been a long day, huh? Well, thanks very much. Maybe you're around. Maybe
sure,
if there is a question later or so. Yeah, perfect.
Thank you.
So I would then ask, please, for my panelists to come up on stage. I will then shortly introduce them. And I will get some water as well. Can you see here? Can you be there? You come to me? Oh, can you be at the end? You're here? Get you some water. I'm not going to ask whether. Thank you. So thank you very much. We heard there is alpha out there and it's becoming much more difficult to extract it. Machines are necessary probably, and data as well. But this is something we want to talk about. Now, before we start off, I'd like to introduce the panelists. Next to me is Amit Goyal. He's a Swiss Finance Institute Professor of Finance at the University of Lausanne, and he's held an SFI Senior Chair since 2008. Professor Goyal's research has been published in the top finance journals worldwide and featured in the international press. His main research interest lies in empirical asset pricing. Next, Roger Hilty. He's a partner and co-head of the trading team at LGT Capital Partners. That is the asset management arm of the LGT Group. He's responsible for managed futures and global macro manager research and portfolio management. He joined the firm in 2004 from LGT Bank. Next up is Anja Hochberg. She has been with Credit Suisse for the last 17 years, if I calculated correctly. She has been appointed Global Head of Sustainable Impact Investing just 4 days ago. So we're really happy to have her. Before, she was responsible for investment solutions on a global level and has been CIO for Switzerland and Europe as well. And Graham Robertson, the far end, is partner and head of client portfolio management at Man AHL, which is a quantitative investment manager. Man Group is a London-based and listed asset manager with offices here in Pfäffikon. And prior to joining AHL in 2011, Graham developed capital structure arbitrage strategies at KBC Alternative Investments. His previous employers include Credit Suisse and Commerzbank. So thank you very much. So as I said already, we start off with a quick fire round, and I just want a little answer from you. So in your opinion, and we start here, in your opinions, do machines play a supporting or a leading role in extracting alpha?
Supporting.
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 I'm going to be boring. Supporting.
Okay, good start. Does data play a supporting or a leading role?
Supporting.
Supporting.
Likewise.
Supporting, but edging on leading.
Okay, interesting. Why is that?
Just the additional value that we see in new data sources is something that's leading the real, lead into alpha for us.
That's a very good point to start. Let's start off with data. We first want to cover the aspects of data. So the additional data that has become available is definitely an alpha source. So is it really an alpha source, and are there many people out there who can manage it?
So I think I agree with Graham. I should have also said leaning on leading. But the reason why I said data plays a supporting role rather than a leading role is because the ideas, this is what Francois was talking about earlier, like the source of alpha generation is ideas. And the ideas are the leading source, and data only helps you test those ideas and see which one of those work or not. In that sense, data, more amounts of data are good because they help me test better, more ideas. But data is still a supporting process to the idea generation, which is the leading role, which is us.
Roger, maybe it would be interesting to hear from you, from your experience. Is there a manager out there who masters big data already, where you've seen models that actually work?
We had a project last year, and we spoke in detail with 10 large quant hedge funds on the East Coast, because financial center of the world is still around New York City. And we asked them how P&L relevant are these non-traditional data sets, because big data should be split into huge amount of classic data, or, and that's I think the interesting part, big data in the sense of non-traditional data sets. What we saw before on the screen, this is satellite images, news-based NLP, scoring news, cell phone tracking devices, consumer data, etc. And interesting is that this included firms like 2 Sigma and many others, we're talking about large quant firms, leading players in systematic trading. And it's interesting that it's not much relevant right now. Even 2 Sigma says 60 to 70% of what they do is based on classic data. The vast majority, between 60, 70% and 100, is a clever use of classic data. Nowcasting, for example, you calculate macroeconomic data fast to come up with a GDP print before the government and authorities issue that. And then some is actually relevant, performs relevant based on these non-traditional data sets. But what they all say is that it's not yet sure whether it's luck, that was also one source of alpha, or whether they really found something.
Anja, if there is more data, is it just supporting the rest of the case? Or is it a new sort of insight you gain from more data?
I would still stick with my supporting view, as I believe integrating data into a proper investment process, and maybe that's where I come from in a structured and disciplined investment process. I think that's key. That at the end of the day, you try to keep or get a competitive edge by integrating new and proprietary data. I think that's what the industry has always done. You always try to be one step ahead and try, with the nowcast, for instance, to reflect current GDP, to be pretty boring as well. For the Swiss economy, there is almost no better indicator than the good old the purchasing manager indicator, because that's something where you're at the heart of the data. So yes, I believe in new data. I think we have to search and look for that. But it's not big data on its own. It's really how you integrate it in your investment process, and exactly when and how you decide what is the relevance of the information. It's not just information, it's really what you make out of it.
Graham, when you introduce new data to your computer models, how do you go about assessing whether the data is good enough? So, I mean, in a sense, how long do you test the data, whether it's actually appropriate to integrate it?
Let me constrain my answer to trend following, which is where we've got probably our strongest history in. And I think fundamentally our belief is that markets can trend. We don't, we've been trading it for 30 years. We think there's good evidence that that works. So if we're investigating a new market, you're typically saying, look, can I get a reliable source of data? Can I get multiple brokers contributing quotes? Not necessarily getting 20 years of data to do it. Otherwise, somebody else would have done it.
Mm-hmm. So that's basically, okay, yeah, good. Anyone else? Okay.
Maybe one point to add, just based on the experience I have made in the last 18 years. We have briefly touched on that the more data, the better, the decision-making process. I think what I have observed is that if the data set becomes too large and you get contradicting signal, you have to avoid that you don't get just to an average opinion, for instance, in a committee. So it's, there is maybe an optimum amount of information you can actually actively handle to really make sure that you have a view of how relevant it actually is. So I think that's always the issue we have with consensus views. If you take too much into consideration, you might not come up with exactly this kind of competitive edge. Here as well.
I have asked this because you're a representative of a bank. If you put up a model to achieve some returns, alpha in the best case, do people buy into this just because they think, well, yeah, it's my bank, they know how to do it, or do they actually want to understand what's going on?
Of course, we do have models as part of our investment process. Of course, we also have quant strategies which people use as part of their building blocks. But if I look at the majority of our clients that actually reach from the more retail and towards the more ultra high net worth clients, I would say the use of black box quanti kind of models is still very limited. I still see, and especially in times like this, that people still would like to know why have I, got certain return on what are the risks. So that's still, I would say, an issue in terms of applying alpha to client portfolios, that there's only maybe that will develop, but there is a limited willingness to buy into black box alpha, at least for the moment.
How do you do that for your clients? I mean,
absolutely, I couldn't agree more. We can tell clients what we're up to, and they're very interested in that. But everybody always wants to know. Tell us a bit more. What exactly are you doing? Can we have this intelligent conversation about machine learning, for example? No. Clients don't want black box. Client wants to find out a bit more, for sure.
If I may
sure.
jump in, so I agree again with you that just the black box is not enough for the clients, for investors, for asset managers. You need to understand where the alpha is coming from. But then I see a little bit of a disconnect. Then what exactly is the machine learning doing for the portfolios? If it's a machine learning and you test out many things, and one of the black box strategies delivers very high alphas, even better than maybe what Francois showed. If you don't believe it, what's the point of this machine learning? If at the end of the day, it's the humans, the intelligent decisions are being taken by humans, I feel that machine learning is just it seems like a hype.
Well, if I just quickly, I would have two thoughts on that. One is, I would use that as a true diversifier. If we are not right with our opinion, if what we call, the big picture of the world is not right, then, something which tells us different the picture of the world might still be needed in your portfolio. The other one, and I think that's where I personally get the most value out of those models, is if they can help me in one way or the other, for instance, well, if you look at factors, for instance, that drive those quant models, to identify where I would have been or where I could be wrong in my analysis. So if I, for instance, see that most of the quant models have made currently more money because of any kind of momentum strategy, I really have to go back, to my strategy. Well, what have we missed in explaining the world that we haven't, been able to capture that in our strategies? There is a more analytical side to it, but also very practical as a true diversifier, in my view.
Maybe if I could comment on that, I think it's slightly more nuanced than this black box versus non-black box. If you think about like what trend following has historically been, it's like, computer, here's what a trend looks like, go and find us some in the data. Whereas the machine learning angle to that is, here's the data set, just go and tell us what you can find. Go and find some patterns in that. And if you throw a machine learning algo at the S&P, say, it'll tell you that the best thing to do is be long over the long term because the S&P goes up. It'll then tell you that momentum works. You buy into the S&P over periods of time, it goes up. If it's going down, it goes down as well. And then you start to get the kind of patterns that machine learning can tease out. That is kind of buying on the dips. Machine learning can spot that when markets go sharply down after a while, then possibly the best thing to do is go long. And is that genuinely black box? I'm not sure it is, because that's kind of classic trader mentality. That's the way people were thinking in February this year. The market's gone down, when do I get in? And that's perhaps where the machine is starting to add some value. It's not an easy problem, but that's a nuance.
You would still then have to have either a machine or a person deciding whether the snapback from this, large sell-off would be kind of V-shaped recovery, or whether it's going to be a more flattish one, or?
Potentially. I guess the machine would try and learn from what's happened in the past, and as long as you can make that kind of inference, it could be true.
It's also in the discussion. Did you want to add to that?
Just briefly on what Graham said, you also have an interesting research paper from Man AHL. There's one picture in it which has Chihuahua dog faces and blueberry muffins surface. And if you don't have it here, but there's a lot of these pictures, and there's a lot of similarities between the two. Between the surface of a blueberry muffin and the Chihuahua face. Sure. And it's very difficult for a machine to identify whether it's a cake or a dog. It's just one anecdote, but I think we have also at LG a large quantitative trading arm and a team who does research just on systematic trading firms, including yourselves. And we have met with many machine learning companies, including professors and smart people from academia. And it's just hard to see the evidence and concrete facts right now. Even the ones, and these are professors, they write in journals, they publish a lot, smart people, and when I ask them, how do you allocate these machine learning algorithms? Generally at this point it's equally weighted, so they don't know themselves. Then you ask, do you add to that risk allocation during a drawdown? No answer. So I think there's a lot of work in progress, a lot of very smart tools in quantitative trading. This will emerge, and I think will clearly have a significant impact on the asset management industry. We just don't see the concrete proof yet.
So maybe it would help the discussion when we would find out, is there actually, people in the survey said, that was presented before, people in the survey said they already have artificial intelligence or machines doing the trading. I think the figure is quite high. What is actually being done by machines today?
The heavy use of classic data has been around for a long time. Since especially speaking about futures trading, managed futures also what is a core part of the Man AHL business. Electronic access to exchanges, to commodities since 2006, and more markets are becoming electronically tradable. So basically, you look at classic data, a man, a woman writes an algorithm, the machine executes, and it's applied to classic information. There's a lot of very good track records out there, sustainable performance over different market cycles, but the humans who program need to continuously advance and enhance to keep up and generate alpha. over time. And I agree with the presentation before. There's a lot of CTAs and hedge funds out there who have, there's no justification to be named a hedge fund or a CTA because they don't generate alpha. But there's a handful who do a lot, and they're really smart and good. So it's very relevant. We have a 17-year track record, just systematic trading portfolio. It works. But on these non-traditional data sets, it's just starting because a lot of these non-traditional attractive data sets, the apps, how they get produced and so forth, the innovators, the entrepreneurs of these companies, their mindset is not first and foremost to generate money or signals for the asset management industry. No, they want to be cell phone tracking devices, they track your health conditions, we want to reduce insurance costs and so forth. And this is all not available through a public cloud to the asset management industry. I think it's just also a lack of availability to program, to test and evaluate this data yet.
Maybe I can answer your question from an academic point of view. The frontiers of research in academia using the big data techniques are, so it's not really using the big data, it's more on machine learning. So we are using the standard predictors. So there's lots of people in the profession, in the academia who have developed hundreds of signals for predicting stock returns. And one can imagine that maybe the world is not so multidimensional. So machine learning is used as a means of dimension reduction. So if there's hundreds of predictors out there, how can we efficiently combine them? Or maybe some of them are better, more better than the others. And machine learning is one of the techniques which can help us in winnowing down the list of signals that one can use in constructing portfolios which could deliver alpha. So that's where the frontiers of academic research are. I don't know as to how much of that is filtered down to the industry.
To add, which is stuff which is relevant for the more advisory side. And of course, on the discretionary side, you have the aforementioned the traders, but on the advisory side, and that's still where most of the money of our clients actually, unfortunately, is to make what happens in the markets relevant for them. We believe big data is of great relevance. So because, as you have mentioned, it can reduce the complexity. It can make what we see in terms of possible options. I mean, you have, maybe if you have hundreds and 1,000 different ways to improve your portfolio. First of all, if you go to an average client, you cannot present and discuss 100,000 possible opportunities. But if you have an intelligent way of finding out which are the 3 most likely ones he or she would like to implement, then the conversion rate of your ideas into advisory portfolios is much higher, and the impact for the client and for the bank is higher.
That's certainly very helpful. We have to speak about technology and humans. That's a very interesting discussion. We've heard figures before. So if a computer comes up with a strategy itself, who decides whether actually money is going to put to this strategy?
Actually, can I, just to follow up, I have a question that I would like to ask, not just the members of the panel, the audience. Just taking your example, if a computer comes up with a strategy, or a hedge fund comes up with a strategy, following some machine learning techniques, and says they deliver an alpha of 2%, 2.5% per month, which is outrageously high, versus somebody who's a little bit more fundamental-based investor, let's say me, simple guy, and I spend my days thinking about ideas, and I do simple classical regression analysis, and I come up with an alpha of only 0.5%. Which fund would you invest in?
Yeah, let's take the question
I'm just
to the floor.
Right. So
I want to see hands.
So how many of you would invest in the 0.5% simple guy versus the 2.5% monthly alphas? I'm talking about monthly alphas. 2.5% hedge fund, machine learning hedge fund. How many of you would go for the machine learning hedge fund?
Machine learning? A few.
Okay.
A few.
Let me just finish the story, and then again I'll ask this question just one more time, and then I'll stop. Now let me tell you that this, I was spending my days thinking, and I came up with 0.5%, which I thought was brilliant. The machine, because it's a machine, it tested out 10 million strategies, because it's a machine, it's supercomputers. And out of the 10 million strategies, it came up with one, which I just presented to you. Are you really now that much impressed that of the 10 million things it looked at, one turned out to be 2.5%? Actually, isn't it atrocious that it came up with an alpha of only 2.5%? So the point that you were asking, the machines can come up with really good statistical things, but I go back to the thoughts that my panelists were talking about earlier. It's too much of a black box. Unless you have an understanding of what's in the black box, I would not advise anybody to invest in 2.5% alpha. You need to understand what's in the black box. So machines can be helpful, but they cannot be the deciders.
Exactly. I was about to ask, who achieves the alpha? Is it the machine or is it man?
One of the largest private equity firms they published a paper speaking about systematic trading, and they've been, pure fundamental and not quant at all. And he wrote that ideally you program a computer that the computer thinks like human, then you give it access to the network, the World Wide Web, to have access to all information of the world, and then you let it trade. So that would be the full concept of phenomenal artificial intelligence. Just does not exist. The same way we analyze these systematic traders, I would say everything needs to have a trading logic behind. Obviously, some have components of new things, new space trading and so forth. We also have initiatives in-house in those areas with a team of 4 people, but the vast majority is still traded on classic data. The CTAs we allocate without an exception, these people and CIOs have a trading background. They've been prop traders in the past, surrounded themselves with smart software developers, programmers, and then they create an algorithm to execute fast, not being tired like humans, and so forth, being unemotional.
So humans achieve the alpha?
A machine is programmed by a human, executes that, and you need to continuously advance and enhance that machine to keep up with your alpha generation capabilities. And there is a saying, you find it everywhere, a man and a machine is always better than a man or a machine. So it's that clever hybrid model and combination. I think that's just where right now the practical relevance is.
What do you think about the
I would have said we should probably view it as not the holy grail. You have the same kind of caveats and pitfalls that you have with traditional quant investment strategies. Overfitting has always been a huge problem. It's probably an even bigger problem with machine learning. So you need a rigorous process, robust research that goes into it to identify whether it's that one strategy that allegedly gets you 2.5% per month as opposed to that genuine edge, which is 0.5%. The story is broadly the same. Your machine learning toolkit is one of many that you should be deploying.
Now, I guess the big question really is, do we need, can there be a world where the robots take over? You're all sort of saying, no, it's really the man or human that decides. But even if a bank, for example, if you are a CIO, even a computer could make the allocations. Would that be a good result for the clients?
I hope computers make allocations at the moment. I don't want to have anyone in team running around and doing, their own little spreadsheet. So you use already computer power to, for instance...
No, I meant the decision, the final decision.
Yeah. Well, in a way, if you have a disciplined investment process, you come already to a proposal which has maybe 80% of machine support behind, if you look through the entire value chain of all analysts taking part. But the final decision on whether this is exactly the risk we would like to go now, right here and right now, I think that's something which, in our case, the investment committee takes. And then afterwards, as next part of the value chain, then you can use, again, machine power to translate this, I would say, very high-level decision into actionable portfolios. So I don't want us to think about, I don't know how many 10,000 of portfolios. You really have then to find, machine way of adjusting that to the right risk level, to the restrictions of the clients. So everything we have, for an efficient portfolio management.
Are there enough people joining the finance industry to think about the problems in the finance industry as compared to the Googles and Amazons of this world? What do you think? What's your experience from that?
Certainly, from our point of view, it's the machine learners or people in that field are very, very hard to find, and certainly seem to have a very high price tag on them because of the likes of Google and Amazon and all these people that use them. Are there enough of them coming in? Well, they're hard to find, so probably not.
I can only add a little bit of advertising for our university. We are training those generation of people, students, who are not only trained in finance, but have knowledge of machine learning. So hopefully in a few years, you'll find these people easier to find.
Good, good.
I think it's important that you can integrate them in a speedy and interesting way. There's always a risk that, especially with I would say, bigger firms, that you can get lost in lengthy processes. But if you can use the power of those people to really have on-the-spot improvements of your processes or your implementation, I think that's great. So I would say a speedboat approach is what we actually need here, instead of really a lengthy kind of deployment over time.
No, I guess the question really is, when it comes to big data and technology, are markets becoming more efficient through the employment of data and or technology? What are you reckoning?
Well, so again, I will give my academic point of view, and then you guys can jump in. I think, in my view, having big data and machine learning has certainly led to a little bit more of democratization of market efficiency, of trading strategies. So these big data techniques are not secret. Most of the people around the world know about these things. So in that sense, these techniques are being applied all around the world. It's not only a province of Greenwich, Connecticut, where they're trading on these kinds of strategies. So in that sense, I think there's good thing about these data. Also, because these techniques are powerful in the sense of computers reacting faster, like you had mentioned earlier. So the markets react to information quicker than they used to. So from those points of view, my feeling is the markets are more efficient than they used to be. Doesn't mean they're fully efficient, they will never be, but the machine learning and the big data have helped in making markets certainly more efficient.
It clearly helps ultimately for all of us in this room, because more efficient markets, more pricing power. The hedge fund world is not 2 and 20 anymore. There's a massive repricing because of all those observations. Also, we have seen from the prior presentation. Generally, market efficiency increases. I would say some strategies have been made redundant or quasi-redundant. We see especially what some discretionary, directional, old-school macro futures trader, some of their concepts have been captured these days by machines. You can trade government bond auctions with an algorithm in a very sophisticated way. If you've done that as a prop trader before, you can program what you have done. So we have quantitative macro strategies. We've made allocations in that area over the last number of years, replaced some of our discretionary global macro managers. But also there's still a handful of very smart discretionary futures trading talent out there, justifies an allocation. In terms of increased market efficiency, new data sets become available. That also creates additional sources of alpha. I think markets can become more efficient, but there is potentially, again, more opportunities to generate alpha. There's always behavioral biases, regulatory biases. So I think it's a bit of both.
I would also add, theoretically, yes. Theoretically, they should become more efficient. In practice, I'm not yet so convinced. First of all, I would say if the easy availability, the democratization of those trades and even instruments, that can easily lead to some overconfidence of investors and could also potentially create some herding behavior here. And that for me would be clearly often concern as well.
Would you like to add?
I would echo those. I mean, the industry has to evolve. AHL started out about 30 years ago, and at those times it was fairly innovative, trading futures markets in a trend following manner, and these days a quant with a laptop can probably do it. So you have to look to different markets, you have to look to different strategies, machine learning strategies, and we have to evolve as an industry.
Maybe to add, coming from a more macro background, the opportunity to achieve alpha is, in my view, not just based on the capability of a manager, but also on the available opportunity set. And you can easily show that in different kind of market periods, that's different. So you don't have a continuous opportunity set that will change over time as well. And in very general way, you would see that strongly rising markets might not come with the same opportunity set than ones which is more flattish. So therefore, I think we should also be prepared, especially right here and right now, to think about that opportunity set.
I think that's a very important point. And I think from the prior presentation, how basically alpha generation has declined on a fund of fund and on a single fund level. Let's not forget that since 2009, we have seen a massive liquidity-driven market environment where there is almost no hedge fund out there which on a risk-adjusted basis did beat the 50-50 stocks and bond portfolio. We have seen a significant low vol environment, and whenever there was a bit of a spike in vol immediately collapsed, and the curve flipped back from backwardation into contango. If you look at VIX futures and other volatility measures, so that has not been an environment for active managed strategies. So I fully agree, alpha generation that was a little harder to achieve because active trading strategies, a lot of risk management, position sizing, being nimble, that has generated negative alpha. So it's not an excuse, obviously, but I think it has not been a rich environment for generating alpha. One other topic which was discussed before, talent, quantitative trading talent. I think there's a massive wave of quantitative, I would say, programmers, professionals, data analysts who enter the asset management industry and have been. A lot of what they do is alternative risk premia or factor investing. And there is also a risk that investors could be trapped in certain hidden risks because there's a lot of crowding. Because if you're a super smart quant analyst and programmer, they're not from the asset management and market and trading industry, so they have a different background. So they apply, and have been in many cases, they apply well-accepted financial concepts and theories. So if a lot of them do the same things, and there are some nuances obviously, but there's a lot of similarities, you can end up with a lot of crowded trades. And many of them have been actually running their strategy and established their strategy after the global financial crisis in 2008, and they have never been tested in a credit crunch or when really risk management was required. So there's also a risk of things are hyped, and it's not all the same, obviously. There's a lot of good ones, but also a lot of very similar ones, and the similar ones for investors is always a big risk to be in crowded trades.
Can we speak, sorry?
If just quickly to follow up, because Anya also mentioned about herding and the crowding of the trades. So this is actually a question that I have for market practitioners. Because many of these quantitative techniques, the machine learning techniques, are ultimately based on a few simple statistical techniques, and people are using the same techniques. Do you fear that we could have a repeat of the quant meltdown of 2007? Something like that you guys fear in your portfolios, in your allocations, that since everyone is doing the same thing, it needs just some trigger, like you said, credit crunch or something to see the effects of this crowding, herding in the machine learning space.
Absolutely. I think, Graham, that would be interesting to hear from you, because a lot of people think, at least that the quant investment is sort of a crowded trade.
I'm not convinced it's a machine learning argument, really. There's possibly more of a case for saying it's a volatility scaling argument, maybe not machine learning. I think if you look at the numbers, certainly the size of the CTA industry relative to the hedge funds or CTAs relative to the futures markets, the numbers still aren't that big, frankly, and it's hard to see that, as really being the factor. I mean, people pointed the finger, I think, in February as the cause, but there were very, very strong technical effects in February with the inverse VIX trading, with the S&P and the VIX going to 50 intraday. I think the jury's out on whether or not that's generally accepted.
I agree, because especially in futures trading, you're also diversified across asset classes. You trade 75 to 150 individual contracts. You're pretty much not in those idiosyncratic events. I think what you refer to is the August 2007 STAT-ARB crisis, when many of these equity market neutral, cross-sectional type of strategies really had big drawdowns because on an index level, equity index level, things were relatively calm. But within the index, you had 20% up and down days on single stocks. And if you do that with cross-sectional strategies, you trade thousands of instruments. Typically, they have 1,000 stocks in the US, 1,000 Europe, 1,000 Asia, apply a lot of leverage, you have significant cross exposure. And then you have similar trades applied by similar machines. You can have events like that. I think that's a little bit the scare of many people right now. We are quite cautious. We have not been actively in that space, allocating in that space. There's a lot of leverage because the risk premium has been compressed. We are at the very end of a cycle, or what we have seen an environment of massive stimulus from global central banks since 2009. To squeeze out more return, you need to apply leverage. And in cross-sectional equities that are equity market neutral, that's what has been broadly discussed, and a crisis could happen. The way we try to avoid it is we combine investment strategies which are just different, so complementary to each other, and also from a trading speed, from an enter and exit, that these different CTAs enter and exit positions based on different techniques in different ways and forms.
Now we have had a huge development in trading strategies and computer power and data, everything we've heard. How can it sounds like a simple question, but how can managers like Renaissance, to speak of a fund we probably all know and is not represented here, how can funds be so successful even though they've been on the market for such a long time? How do they do it? Do they just invest a lot of money, a lot of computer power?
So, again, I'll give my academic view, and I guess most of us don't know what Renaissance does, so it has to be only a view. And I'll take that question a little more broadly. I think we've talked about these machine learning techniques, analyzing big amounts of data, but one thing we haven't really touched upon, but I think the machine learning can be very useful is in high frequency space, in analyzing trades, just executing trades based on high frequency flows. So essentially liquidity provision is something where the machines can do this job of liquidity provision much better than the old age of the specialists and the market makers and so on.
So you avoided the Renaissance question.
So it could be. I think again, I don't claim any special knowledge of what Renaissance does, but it's possible.
But do I understand? So you basically have to innovate, and through digitalization, you will get new sources of alpha, presumably.
In the space of liquidity provision, in the space of, not in the sense of traditional forecasting of returns as to which markets, indices, stocks will do well, but just in terms of short-term flows, predicting the price movements in the next seconds or milliseconds, and so on.
Anyone wants to add something?
I think Renaissance Medallion is really the one where nobody knows what they exactly do. We had also meetings with them in the past. It's hard to get any numbers. They returned all capital to investors. It's basically employee. The asset base consists of employee money. Employees, I think, if you ask some of them, they also don't get on a monthly basis an NAV statement. We heard that people operate literally in boxes on a standalone basis. The life cycle of these models is very short because they go into that super fast space in liquid markets. But I think it's just speculation. Nobody knows exactly. No. On the other hand, Renaissance also tried with a futures program. Reef and Reef, one was an equity program and one was a futures program. I think AHL had superior results versus them. And on the equity side, there have been many others in cash equity markets on a systematic basis, which also have done better. But what is in Medallion, I think that is really, I would say in systematic trading, that's the only true black box where also our analysts don't get access, no transparency, and obviously there is no opportunity to allocate to them.
Well, of course, you can't speak about a competitor, but tell me more about, to finish off, we're coming to a conclusion before we take some questions. You said new markets will become online, and that really was sort of the one part where your firm could evolve your the trading model. Can you be more specific? Is this about the digitalization? Is that what's going on? I'm
probably in the wrong panel to answer that question, because what we've actually found in trend following space is that the biggest additions that we can make to make our returns better is not by changing the model, but actually accessing different markets. Mm-hmm. You know, by looking, you know, typically the big futures markets, you know, they're focused on G7 macroeconomics, and they've had their difficulties post-credit crisis. But if you look at genuinely esoteric markets, like you know, hydroelectric power markets or interest rate swaps, you get, you know, better environment for trend following. That's really where I was coming from, and also my initial comment about the data was kind of coming from that as well. So it's not so much about the models in that case, but just the accessing different markets really makes a difference.
But is digitalization helping in a certain sense, and electronification of markets?
In a sense, so the market where that's relevant, I mean, yes, I mean, more markets are coming online. I mean, if you look at something like, you know, central clearing of CDS, for example, enables more people to trade it, you know, that's happening more, if you call that digitalization. So yes, that can improve things in that domain, but genuinely different markets, you know, are where the juice is for us.
Okay. I'm being aware of the time. I think we leave it at my questions, and you probably heard enough of me. But I want to ask you whether there are questions in the room. Monsieur L'Habitant is here as well. Sorry, yeah, there. Could you wait for the microphone, please?
Yes, my name is Matthias Schnaab. I'm from Opalesk, the media company. Not just really a question, but maybe a brief comment, and putting a few things together that came up during the panel. Now, we saw the number 56% of investment managers are looking at AI and artificial intelligence and machine learning in their investment process. Now, when we read this, we always think of, okay, they're going to do idea generation and they're looking for strategy. But I think this came out in your panel also very well. This is just one part. If we look at the investment process, you have the idea generation, you have the portfolio construction, then you have the execution, right? So Amit said that, you know, in execution, you basically today, you don't have the execution trader. This profession is gone, replaced by computers, and they're getting better and better at it because they're in a position to instantly analyze the flow and make the decision and make those, right?
And your
the same
being?
thing, execution trader, so it's the execution. And then Dr. Hochberg talked about it's the computers that do the portfolio construction because they're better, proven better than humans. So when we hear these numbers, 56%, I just wanted to point out, some of them will be doing ID generation and alpha, and then the other ones are also looking at execution and portfolio construction, that the applications of artificial intelligence and in AI is just broader than just the looking for the next strategy. Just as a comment.
Does anyone want to comment on that?
So I think, again, Francois, from what I took from Francois's presentation was that there's many hedge funds, many of who claim to do machine learning, but the idea generation part of machine learning is done by very few hedge funds. I don't know if I understood what Francois was talking about correctly. So you're right, that many of them who claim to do machine learning, you should not take that to mean that they're doing idea generation through machine learning. They are doing other important things about portfolios, but not the idea generation.
I would maybe just add to that as well. So, I mean, machine learning is a part of our execution platform as well, helping us. You know, we have algorithms in there called multi-arm bandit algorithms that help us choose route to market. So yeah, they are, you know, in alpha generation, but also in execution as well.
We talked a lot about the investment signals. I think based on the classic data or non-traditional data, I fully agree. Because once you have a signal based on a certain data set and based on a certain investment technique, then it's about how you size those contracts, which markets you want to be active, how you combine it on a portfolio construction level, and then execution. And there's this whole value chain, which is not insignificant, which ultimately then leads to the net performance result, and there clearly in these different stages, machines in some cases have a superior role versus humans. And execution, some have co-located server where that millisecond advantage is largely scalable on a big asset base. It's a question. They have a co-located server in front of the Chicago Mercantile Exchange and others. So all of these techniques exist, and I think there just humans cannot keep up with the speed of machines.
It's awfully quiet. Oh, no, there's a question.
Magdalena Standera, quant analyst. I have a question. CTA performance has suffered in the last few years, and now with machine learning, what do you see for the future? Increases in volatility. Do we expect better performance in the future?
I guess I'm the victim for that one. I mean, I kind of alluded to it earlier. We've seen the CTA industry has definitely struggled post-2009. We think, we've always thought that the smoking gun for that, if you like, was more the interventions of bankers on markets and causing increase in correlation. And generally speaking, as a CTA, as a trend follower, you need two things. You need trends at the single market level, but you also need low correlation, so you can find trends in lots of different places. So hopefully with the confluence of these two, you should look at better returns going forward. Machine learning will hopefully help that. You know, if we diversify the number of ways that we can capture trend, that can only be a good thing.
No other questions? Thank you very much. Let me please thank you, or thank the panelists, Amit Goyal, Roger Hilty, Anja Hochberg, and Graham Robertson. Thank you very much. You can just stay here for a sec. I'm just closing. Thanks very much, not only to the panelists, to you, also to all the panelists who have been here and all the speakers as well. We are closing this event for today. This has been the 7th Swiss Asset Management Day. I really enjoyed it. I learned a lot. And I'd like to thank my co-organizers, the Swiss Finance Institute and the Canton of Schwyz, and of course all the sponsors who made it possible to be here today. I will take from today that our situation regarding climate change is really dire, even worse than I thought. I have learned that the concept of goal-based investment is really interesting, but it's hard to understand, at least at the beginning. And we've heard the alpha versus the beta debate in a digitalized world, and we've heard very interesting contributions from the panels. Let me conclude. The drinks are waiting outside, so thank you very much, and I hope to see you next time. Thank you.